Hey, it's Tom here and welcome back to the channel. So this is going to be part 2 in the two-part series on investing checklists. Now, investing checklists are pretty widely used by a lot of my favorite investors, Guy Spear and Monish Prabrai most notably, and I've recently sat down and gone through the exercise of creating my own checklist when it comes to investing. Now, checklists are very personal, and I've tried to pull kind of various aspects from other people's checklists, but also put my own kind of spin on it. And the purpose of the investment checklist isn't necessarily to say that any investment I make has to have all of these characteristics. It's really to kind of pull me up and make sure that I prompt myself to think about things that I personally am sometimes prone to missing. So there's things with particular investments I just think about automatically. There's other things that sometimes I just miss and I've made mistakes on in the past. And the checklist is really there to kind of stop me making any kind of dumb errors before I go ahead and make an investment into a new company. So in the first video, we covered meaning or understanding the business. We also covered moat and management. And in this video, we're going to talk about margin of safety and kind of valuation. And we're also going to talk about some final checks or a list of sort of final questions that I want to ask myself before making any new investment. But before we get into that, we do have a sponsor for today's video, and today's sponsor is Hatch. Now, Hatch have been my personal broker of choice for more than 2 years at this point for me making all of my US investments from here in New Zealand. I initially switched across to Hatch basically because of fees. I was paying $90 US dollars a trade to make investments in US stocks through one of the big banks here in New Zealand. And unless you're, investing really sizable amounts of money, that can chew up a lot of your capital, and you can kind of have to make fairly substantial returns just to earn those brokerage fees back. So Hatch have been a lifesaver in that department. I can make those exact same trades that I was paying $90 US dollars per trade for before for as little as $3 US dollars. So they've been a massive money saver on fees. And they've also continued to improve the platform as long as I've been a customer. So one of the big, more recent additions this year is the introduction of kids accounts. So if you want to get the compounding journey and the snowballing of wealth kind of started very, very early for your kids, you can now set up accounts for your kids with even lower fees than the traditional Hatch accounts. So if you're interested in checking out kids accounts, or if you're interested in checking out Hatch more generally, you'll need to go to the link hatch.as/investingwithtom. If you go to that link, start a new Hatch account and deposit 100 New Zealand dollars into that account, Hatch will give you a free $20 top up so that you can get started investing with a little bit more money. Okay, so the first point on the list here is the stock cheap enough in absolute terms, not just relative to others in the industry? So this one actually comes straight from Guy Spear. He gave an example of basically like a food business that he purchased into. He writes about this in The Education of a Value Investor, where, relative to other companies that this particular superstar CEO had managed in the past, the stock looked cheap. Like if you looked at it on a PE basis relative to some of the businesses he had been successful with in the past, it looked cheap relative to those things, but he was still paying something like 30 times earnings for a business that was growing, but not growing at crazy rates. And at the end of the day, even if a business is cheap relative to others in its industry, it does still need to be cheap kind of in absolute terms and relative to businesses in other industries that you can potentially invest in as well. So that's the first one in the margin of safety section. The next one is kind of debt focused, or the next couple are debt focused. So does the company have sufficient liquidity to meet their debt obligations? So there's a couple of things that I kind of check here. Firstly, I will generally go into the 10K, the annual report, and just search through until I find debt maturities. So that will typically tell you how much debt is due at a certain period of time. And what I'll do is I will kind of look at the current cash position of the company. So, in certain situations, they might have net cash, so they might have more cash than debt, which they clearly have enough liquidity to pay down those debt obligations. In other situations where it's maybe a tighter kind of gap between the amount of cash they have and the amount of debt that they have, maybe they have slightly more debt than cash, I'm really going to be focusing on when do they have payments due and how much cash flow can they generate kind of between now and when those payments are due. So that's the next one on the list. The next one we have is, could a short-term event significantly impact their ability to meet debt obligations? And the example that I've listed here is airlines. The airline business is one that has a lot of kind of operational leverage, so they can go from earning modest profits to losing money very quickly. today. And if we have some sort of macroeconomic event like we did in March 2020, that can really impact the equation in terms of the airlines being able to repay debt. So that is why that one belongs on the list. Could a short-term event impact the ability to meet debt obligations? Next up, are revenues dependent on credit markets or the price of a particular commodity or something similar to that? So there's a few examples I can use here. Guy Spear talks about a credit market example with his investment in CarMax pre kind of financial crisis. You could also throw in basically any commodity company here. So whether it's gold miners or steel producers or lumber mills or anything like that, they are very, very dependent on a commodity price. That's not to say I will never invest in a commodity business, but it's really important to understand what the profitability of the business looks like at a range of different kind of commodity prices, because that can really impact things substantially. So that's why I've got that one on the list. And we've got a couple of kind of summary questions here in the margin of safety or valuation section. So next one is, am I likely to have a permanent loss of capital? Now that sounds like a pretty straightforward question, and the point kind of is that when you get to this sort of question, it should be basic. It should be simple for you to answer, because you should have a very clear picture of what's the upside, what's the downside. So, I really want to understand where could things go wrong, and what kind of percentage probability do I think that each of those situations have. So is there some risk that would just destroy the business, and do I think that's a pretty low percentage risk, or do I think it's a high percentage risk? So before I put money into anything, the first thing I really want to understand is the downside. So if it's likely I have a permanent loss of capital, then it's not one that I should really be investing in. So that's that one. And finally, in the margin of safety section, is the downside small and the upside huge? Now this is one that actually comes from Sam Zell, so I'm probably going to butcher this quote. I will try and put it up on the screen here, but Sam Zell has a quote that goes something like, business is easy. You look for opportunities where the downside is small and the upside is huge, and that's all you kind of need to think about, and those are the things that you need to do. So I've added that to the checklist here, and the example I've got is Apple at 10 times earnings. So this is Warren Buffett's arguably most successful investment ever, not maybe in percentage terms, but probably the stock he's made the most absolute kind of number of dollars on would be Apple. And when you buy a great business at 10 times earnings, like you did with Apple back in 2016, the downside's pretty muted from a valuation perspective, and because you're buying a business that produces a lot of cash, and the upside is potentially huge. As the business continues to grow, and as you potentially get some multiple expansion on that 10 times PE as well, that gives you that really nice low downside, high upside mix that we're all kind of searching for. So Apple is the example I've got for that one. Okay, so that moves us now into the final section. So we've talked meaning, management, moats, and margin of safety, and I now sort of have like a final checks section of this checklist. So these are sort of the very last steps or very last questions I kind of want to ask myself before I make an investment. So there's a few here that probably kind of just get at the same thing, but I think they're nice questions to ask, and they prompt kind of the right kinds of thoughts in my head. So first one is it a cinch? So this comes straight from Charlie Munger. At the end of the day, I am not the smartest person in the world, and I'm certainly not the smartest investor in the world either. So I want to be investing in no-brainers. Now, that doesn't necessarily mean I won't invest in businesses that have some complexities to them. But once I'm kind of through my investment research, I really want to be very clear on understanding kind of the odds, the upside and the downside. And, I want to be very comfortable and have a high level of conviction in that investment. So is it a cinch is the first kind of final check that I have there. Next one on the list is, could operational leverage quickly ruin the investment case? Now, I won't speak too much on this because I've already talked about operational leverage with the airlines, but this one that's gotten me into trouble before, and that is the exact reason it's on the list. So I have a video around my investment in Fiat Chrysler, which I took a small permanent loss on. It's the only stock I've ever locked in a permanent loss of capital with, and operational leverage was a big reason why that investment kind of went a little south for me. So that's the reason that one is on the list. Next one we have is, do other smart investors own it? And a note here I've got is, and own it in size. So when I say, does a smart investor own it, I don't really want to look at a mutual fund that owns 200 stocks and it happens to be one of their 200 or something. I want to see this in a portfolio, ideally of an investor that I really respect, and ideally I want to see them with some serious money in it, 5, 10, 15, 20% of the portfolio maybe. Again, like many of the things on this checklist, that doesn't mean I will only invest in businesses that super investors own, but it is a nice check to have to make sure that there are other people that have a pretty similar investment philosophy to me that also agree that this looks like an attractive investment. So that's a nice check to have as well. So next few questions are probably a little more around portfolio allocation, but I'll kind of keep working through them. So is this way better than the index is the next question I have on the list. So we know that index funds outperform most professional investors. So in order to do a lot better than the index, especially when you factor in mistakes and so on that are kind of inevitable and par for the course, I really want to have opportunities that are obvious to me that they're better than the index. I'm not really that interested in opportunities that I think might be better than the index or I think are maybe a little better than the index. I'm really only interested in opportunities that are way better than the index. So that is why that one is on the list. Next one, in a similar vein, is this almost certainly better than other holdings? So something I have been guilty of before is basically buying into new stocks, so positions that I obviously like. I understand the upside, I understand the downside, but after kind of making those purchases and just taking a step back, oftentimes I've kind of looked at that relative to other stocks that I already have in my portfolio, and it becomes kind of clear to me that I was probably just better off buying more of an existing position rather than adding a new position just for the sake of diversification. And it reminds me of this whole Monish Pabrai quote of, oftentimes the mistress looks hotter than the wife. A new stock looks more attractive than a stock you've held for a long period of time, but as Monish Pabrai goes on to say, the wife is almost always hotter. So it's important to stick with the businesses that I think you really understand best and you understand the real nuances that can sometimes happen in certain businesses. So I really don't want to be adding new positions if I've got things that are more attractive at current prices that already sit in my portfolio. And the next question on the list is almost the same thing, but just worded slightly differently. Would you rather own more of an existing investment? And I've got a few notes on this one, so I want to prompt myself to think of the upside potential, the downside risks, and how confident I am. So in order for me to add a new stock to the portfolio, it needs to kind of tick all those boxes. So it needs to have less downside risk and more upside potential. Otherwise, I'm better off just buying a position already in my portfolio. And the kind of only exception to that really is if maybe I think it doesn't have quite the downside protection, or maybe it does have downside protection, but I don't think it has quite the upside. But maybe I'm a lot more confident in this new position than one that's already in my portfolio. That could be an exception, but I really just want to make sure that I'm thinking through those things very clearly. And getting to the final few points on the checklist now, is this the best opportunity I've seen all year? I'm a big proponent of sort of the punch card analogy in investing. I only want to make maybe 1 or 2 new investments per year, and if I can find 1 or 2 new investments a year, then I'm happy. So I don't need to be super active. I don't need to be hyperactive when it comes to making changes to the portfolio, adding new positions, buying, selling, trimming, all that kind of stuff. I really just need to find 1 or 2 new things a year. So if I'm even remotely considering buying something, it had better be the best thing I've seen all year. So that's exactly what that question prompts. And again, it's kind of just one of these ways of trying to make sure that I don't add things to the portfolio just for the sake of diversification, and I don't just get some great new idea that I think is amazing and quickly buy it. I really want to understand the odds and have a good understanding of the situation more generally. Next checklist item is, would you be confident putting 20% of your net worth into this position? Now, this is something After Dinner Investor has been talking about recently, Jason. We spoke about this actually on my podcast that we recorded a week or so ago. And this is something he called the Brad Bar, as Brad Kellner has kind of implemented in his portfolio with going for like a 5 by 20% kind of allocation. For me, that doesn't necessarily mean only making 20% kind of allocation sizes when I add a new position. It's more about just making sure that I'm comfortable that if I'm going to put even 1% of the portfolio in it, I would be comfortable maybe going as high as 20%. So it really just speaks to conviction levels more than anything. And I have two final questions on the checklist. So the first one is, what would Charlie and Monish do? This is really me just putting myself in Charlie Munger or Monish Prabhai's kind of shoes and trying to think through the situation as they would. And I've added some notes here around Monish Prabhai's classic saying of few bets, big bets, and frequent bets, which comes from the Dundo Investor. And again, along similar lines, the final point that I have on the checklist before making a new investment is, what would Warren do? I think I had a comment on around this on the channel maybe like over a year ago at this point that I should put what would Warren do on a t-shirt or something. If you're interested in that, let me know. But I've put some notes here that Warren Buffett's rule number 1 of investing is never lose money, and rule number 2 is never forget rule number 1. So that is the very final thing that I just want to make sure I'm comfortable that if I was a young Warren Buffett, or maybe even an older Warren Buffett, that I would be comfortable with putting money in this situation. And that is the full checklist. So I do hope you enjoyed that video. This checklist will continue to evolve over time, I'm sure. And I really hope that it will kind of, keep me out of some potentially expensive mistakes. I know Guy Spear and Monish Prabhai have talked pretty extensively about checklist investing, and they're quite confident that it's saved them a lot of money from making some potentially simple and kind of dumb errors. So I hope that that's what the checklist does for me, and I hope these couple of videos on checklist investing are a good bit of motivation for you to start building your own checklists if you haven't already as well. But that's really all I've got for this video. If you're interested in the Hatch offer, you'll need to go to the link hatch.as/investingwithtom. If you did enjoy the video, please hit like and also subscribe to the channel if you haven't already. But that's it from me, and I will see you in the next one. Cheers.